In this video, I'm going to be going over 3 mistakes dividend investors make when selecting a dividend ETF or constructing a dividend ETF portfolio. And I'm also going to briefly discuss when it may be okay to make some of these so-called mistakes. And when I first started investing, I myself made some of these mistakes. So just keep in mind, we're all susceptible to them. And if you are doing this right now, that is okay. And if you are doing it, there might be a good reason for it. So don't think that these are be-all, end-all mistakes. Just consider them a generality of dividend ETF investing. And before we get into it, be sure to like this video if you appreciate the content, and also subscribe if you're not already subscribed for future content. So we're going to jump right into mistake number 1, and that is not knowing the dividend ETF that you are investing in. And this could be a pretty common mistake, especially because there are so many dividend ETFs to choose from, and there are so many investment suggestions that anybody can read online that it's pretty common for investors just to invest in something based on the recommendations of somebody else, or just because it may look good at the surface level. So how do you prevent this? What can you do so you do understand an investment? Well, fortunately, every single dividend ETF basically has a fund page. So I'm going to be going over one of the quick fund pages for the most popular dividend ETF there is, and that is VIG, or the Vanguard Dividend Appreciation ETF. And I'm not going to speak directly about this ETF so much, but I'm just going to show you kind of the information you can find about it. So a little bit of research. If you just type the ETF into Google, the Vanguard Dividend Appreciation ETF, VIG might not return that many results because it is just 3 letters. Unless you put VIG ETF, then you may get an exact match. Typically what you'll see is a historical performance chart, and you could basically go through that. But what we are looking for is the fund page itself. And since the ETF is run by Vanguard, we see first up here that the page for the VIG dividend ETF is pretty much out in the open. So I recommend everybody does this when they invest in an ETF, is look for these fund pages where you can get all the information you'd like about the ETF without any external commentary. Even people that watch my videos when I speak about these ETFs, I encourage everybody to look for these fund pages to get a good overview of this ETF, or even an in-depth description of this ETF. Now, these fund pages usually have general descriptions, the expense ratio of the ETF, the assets under management. You see here the product summary gives you a very decent overview of the ETF itself. And if we do scroll down a little bit, you basically see historical performance, the expense ratio, as I said before, what it basically tracks, the volatility measures itself, the historical price, and other basic statistical factors, and also fundamental factors like the number of stocks, the market cap, earnings growth rate, so on and so forth. This is all good and well, but what if you want a little bit more of an in-depth description? Now, down at the bottom of the page for VIG, this is at a different location for pretty much every ETF. Some are right out in the open, some you have to scroll down for, some are at top, but they're going to have a fund literature segment with the prospectus and other reports. So we click on that link and it brings up a range of links that we can look at, and it is pretty much the recent reports, whether they be annual or semi-annual, and also look for these summary perspective PDFs that they publish as well. That is going to give you a bit more of in-depth information than just the immediate fund page. And if we open that PDF, we do get the prospectus of this ETF, and you're going to get a much more informative version of that initial fund page that I showed you before. This is going to basically be going over all of the risk this ETF has, its historical performance, what it tracks, and so on and so forth. So it is pretty descriptive, and it generally provides a decent summary of what the ETF does. So unlike the initial page, this gives it a more in-depth description of how this ETF invests, and it is a lot more concise in the fact that it pretty much provides a very good description of how this ETF invests rather than just a brief description saying something like, oh, the ETF invests in dividend growth paying stocks with a history of growing dividends. This actually goes into the index that it tracks, and then also kind of gives a description of that index itself. So if you want to invest in VIG, for example, you see that it invests in the S&P US Dividend Growers Index, which consists of common stocks of companies that have a record of increasing dividends over time, and the fund attempts to replicate the target index as best as possible. So just to reiterate, mistake number one is a pretty easy mistake to correct. Just read the fund page before you invest in an ETF. Of course, you may get some good ideas about this ETF, whether they be from my videos or from other videos online, or even from posts online, maybe blogs or whatnot. But after you read or watch that material, just please go and look up these ETFs, and you'll find their fund page, and you'll get a more in-depth summary and review of the ETF itself. And unlike the next two mistakes I'm going to say, there really isn't much of an excuse of why you should be making this mistake. The other two mistakes may be okay to make depending on your investment strategy in particular instances, but this definitely is not a mistake you should be making. It is pretty easy. Just again, read the fund page so you get a better understanding of the ETF. Mistake number two, and this is a very common mistake when it comes to dividend investing as a whole, whether it be a dividend ETF or a dividend stock, chasing yield. Now, this is one of the most popular results when you type into yield on Reddit. It basically comes up what is considered chasing yield. And it is a common concern that people speak about and try to mitigate from. So basically the person's post is what is considered chasing yield. I've scrolled through the sub and seen some portfolios where people are indicating to them that they're yield chasing. What are the key indicators that you are chasing yield? Is there just something you look at and decide for yourself depending on the magnitude? I've seen someone say it's got to do with your yield on cost, etc. Just wondering if somebody could clear this up. And the first response is pretty much the perfect statement about what yield chasing is. Choosing a stock based solely on yield and nothing more. So it basically is as simple as that. You see a high yield, let's say it's 10%, and you select the ETF or stock based on that. And the next person actually does say a good thing too. There is no textbook definition, and some people use the term more loose than others. I would agree with that. It is a very loose term because there are some examples when so-called chasing yield may not be too bad depending on your investment needs. But I do, of course, probably see more dividend investors, whether they be into stocks or ETFs, pretty much just going for the highest yielding asset that they can get their hands on. Now, this is less about the specific ETF itself, but as an example, I used QYLD, the Global X NASDAQ 100 Cover Call ETF. It is a very common ETF for investors that want a high yield. As you can see here, this pays at 11.7%, almost 12%, let's call it. This is a pretty high yield when it comes to dividend investments as a whole. Now, let me give you a reason why, especially if you're younger or want more growth, that is a bad idea to go about investing in these high yield assets. So basically on Portfolio Visualizer, as an example, I put $10,000 into SCHD and $10,000 into QYLD. Now, SCHD is a dividend ETF, an extremely popular dividend ETF. It pays a dividend around the 3 to 4% range. So it is more of a mid-tier dividend ETF, and that is going up against, again, a high-yield dividend ETF. And this back test is going to be a little bit more than 10 years. This is going to be from January 2014 to March 2024. And of course, I did this with dividends reinvested because that is probably, if you are a dividend investor, what you're planning on doing, especially because people speak about the benefits of dividend reinvestment so much. And we are going to see that your investment would not have performed as well as SCHD, that lower yielding ETF there. So QYLD basically lagged SCHD over this 10 years by $10,000. Now, QYLD, with those dividends reinvested, it definitely did grow over time. But of course, if your goal is capital appreciation, which is definitely a benefit of investing into equities, you're just really not going to get that as much as QYLD. Now, when is it okay to invest into a high yield ETF? So again, I don't want to just focus on these specific mistakes because sometimes it's reasonable for people to go about investing in these high yield ETFs. So what is an example of that? Well, let's say you don't have millions of dollars to invest and you're older. And again, I'm just using QYLD as an example. I don't want you to think that that's the be all end all ETF of high yield ETFs to invest in. But if you have, let's say, $500,000, that 12% yield will give you a little bit more than $50,000 a year in dividend income. So if you need to live off of that money, your $500,000, you're not going to be able to do that with SCHD, which is only going to be paying you around $15,000 a year on that $500,000. You're going to need a high yielding ETF to do that. And of course, the options, one of them at least, is QYLD, which has a 12% yield. At the same time, you also have to understand, because you're not reinvesting those dividends, your principal balance will more than likely decrease. So we have that $10,000 that actually went down to $7,000 over that 10-year timeline. So you lost about $3,000. And again, if you were using that money to live off of, probably not too bad, because you really don't care about your principal over time, as your living expenses are likely more important. And you see an ETF like SCHD with those dividends not reinvested still increasing over time. So SCHD pretty much doubled over that same time frame. And that is even without those dividends reinvested. So again, the mistake is just simply chasing yield and not understanding maybe the investment itself, and just hoping that this yield is going to do magnificent things for you, when the intent really isn't capital appreciation, it's current income. And again, if you are somebody that needs that current income, then it might not be a mistake. It might be seen as reasonable at that time for you. And mistake number 3, and this is a little bit of a pet peeve of mine. Now, this can pretty much happen to any portfolio in itself, even dividend portfolios included. And I actually saw one of my family members investing this way, and he showed me all of his holdings, and I was like, geez, that is a lot of over diversification in that portfolio. Now, of course, this isn't my family member's portfolio. This is just somebody's portfolio that I found on Reddit because they posted it. And mistake number 3 is just going to be having so many of the same ETFs that pretty much do the same exact thing. It is so much cross diversification that you don't really get the benefits of any single one. So in this one, this person invests in SPY and VOO. Like, they track the same thing. Why are you doing that? Pick one or the other. And then they also have VTI here, which pretty much like 80% of it is the S&P 500 itself. VTI is a total market ETF, and pretty much the entire market, at least 80% of it, is the S&P 500, which they're already investing in by double diversification through SPY and VOO. So that is kind of pointless in itself. Then they also do have a bit of QQQ, which is also slightly covered by SPY, VOO, and VTI. Now, SCHD in here might not be so bad, because a lot of the SCHD companies are going to be lower weightings in SPY or VOO. Like, these ETFs are much more weighted into the tech sector, especially QQQ, and SCHD not so much. So this person, like, if they only had, or if they did QQQ, SCHD, and VOO or SPY, basically pick one or the other. I would suggest VOO because it's a lower expense ratio. That would be a bit of a better portfolio. They could just take out 2 of these and be significantly diversified, because SCHD QQQ and VOO, they do have some cross diversification, but it is not so much. You could argue, and I would also say the same thing here, that VOO and QQQ are probably too cross diversified in themselves, because VOO already has a significant portion of QQQ's assets. So you might even be able to take that out and just do SCHD and VOO in itself. And just to drive home another one of these examples here, I brought up another person's portfolio that shared it on Reddit, and you just see a lot of unnecessary diversification. And all of these ETFs, in one way or the other, kind of track the same thing in some regard. Of course, there are going to be some differences, but a lot of SCHD's holdings are going to be in VYM, DGRO. JEPI kind of mirrors SPY in a way. SPYI actually does covered calls in a way on the S&P 500, while JEPI's portfolio is a little bit more diversified than just the S&P 500. And then they put in all of these other ETFs like FEPI, JEPQO, which is a stock, QQQI, and then Main. And I don't know what this is, but just another holding that they probably shouldn't have. You could definitely clean this up and probably just do like SCHD or VYM, DGRO, and then JEPI. So I pretty much eliminated all the other holdings, and your overall yield is probably going to be the same. And there's just so much less clutter, and you don't even have to think about everything else. You can set those and forget it and not worry too much about cross diversification as much. So just to reiterate, the mistake there was holding too many ETFs that essentially do the same thing. So when is it okay to make that so-called mistake, or maybe not so much mistake, but when is it okay to diversify your investments? And I would say it's okay to hold other ETFs if their investment methodology or what they hold is somewhat different overall. I would say 80% of the holding shouldn't be in another ETF. So I have SCHD in my income portfolio and also JEPI. There's very little diversification. They complement each other very well. JEPI is a high dividend yield ETF. It pretty much pays you monthly, does covered calls, and selects a group of well-diversified stocks that exhibit a history of low volatility. And SCHD is kind of a blend between dividend growth and dividend yield. Select stocks that have a history of growing their dividends over time, and then further filters them based on financial ratios. And then in my growth portfolio, I have VIG and QQQ, and there is very little cross diversification or cross holdings in these two. Of course, VIG I do think holds some Microsoft and Apple, but it is not super overweight, and QQQ of course holds that too. But something like 90% of QQQ is not going to be in VIG because this is focused on the NASDAQ, a tech heavy index, and VIG is more focused on dividend appreciation. Actually, it is completely focused pretty much on dividend appreciation. And you really don't get that with the NASDAQ. So there's very good diversification when holding these two together. And if you look at all the holdings in its entirety, then basically what you find between VIG, QQQ, SCHD, and JEPI is that overall there's really not too much overlap. So you're significantly diversified and getting all the benefits of holding each individual ETF without the clutter. So I hold 4 ETFs, and I see no need to get another ETF because I'm just significantly diversified. There's no other ETF I feel that would diversify me more. And if I selected one, I'd probably get into what I basically spoke about as a mistake, which is just that over diversification and holding too many ETFs at the same time. Again, I made some of these mistakes too, and years prior my portfolio was kind of a cluttered mess, but I found that once I cut the holdings down to basically the 4 holdings that I had, I was significantly diversified. I looked at all the holdings themselves, saw the stocks that they hold, how they invested and basically said, hey, like this is enough diversification. I don't need all of these other ETFs. So let me know if these are some of the mistakes you made. Again, some of these mistakes are okay to make, like if you need current yield, or if you are looking for ways to diversify your holdings without selecting ETFs that hold the same thing. Remember, if you did appreciate this content, leave this video a like, and if you're not already subscribed, subscribe for future content. It would be greatly appreciated, and I'll see you all in the next video.